Welcome to the Real Estate Vibe Show. I'm your host, Winky Loomba, a commercial real estate investor. And every week I try to bring an awesome guest on my show with an awesome success story. And today I have Stefan I with me. He's the founder of Realty Quant, a company that brings data-driven and quantitative techniques to real estate industry. Stefan is a financial engineer turned multifamily investor, is an analytics speaker and a live webinar host. He holds a master's degree in financial engineering from Columbia University. And during his finance career, he managed 90 billion with a B, directors portfolio jointly with colleagues. Today, we'll discuss Stefan's data-driven real estate investing strategy. Welcome, Stefan, to the Real Estate Vibe Show.
Hi, Vinky. Thank you for having me.
I'm super excited to be with you today. I'm really excited to learn about this data-driven approach. So before we get started, would you please share your background with us briefly?
Yeah, absolutely. And thanks for introducing me with the bio as well. And yeah, so I am Eastern European originally myself, Bulgarian. I came to the States at 22 for my master's, like you mentioned, financial engineering at Columbia. And I worked in the financial industry for about a decade. And in the recent, like 2-3 years, I've been in the multifamily, small multifamily and transitioning to commercial multifamily space in the real estate industry. And I'm founder of Realty Quant, which is a technology, data science, data analytics company in the real estate industry.
Great. So since we're going to be discussing the data-driven strategies today, please share with me, how did you get involved with data, or what piqued your interest in data? I mean, we live in information technology age, but still like to ask this question.
Right. I mean, I think like it's for most investors, like, you know, as we know in the industry, like finding deals is a big, a big draw and advantage. And so for me, like when I started in real estate, so I first purchased like my house, like a house hacking kind of strategy in New Jersey. And okay, I liked real estate. I thought it could be a market that perhaps I can start investing in more professionally, more seriously. And so I started in the New York City area. I started like pulling, let's say, like thousands of like on market, off market listings, for residential properties, and kind of looking for deals this way. And I was able to kind of generate deal flow like that and like do like different real estate projects in the area. And lately I've been like doing condominium conversions in like downtown Jersey City, kind of primary markets, like in downtown Jersey City, Weehawken, and like places like that, like very close to Manhattan. And so all that was like done like with various like kind of underwriting deals in a very automated way across multiple strategies. So let's say if I want to convert a residential property to commercial, I would build this strategy into my model, and I would kind of like search like thousands of listings for that. And if I want to do a condominium conversion, which is like kind of converting a multifamily to condominiums, okay, I would build that strategy also into my model and kind of search thousands of listings for that, right? Or if you want to just like have cash flow, like high cap rates, things like that, okay, have that as well. So kind of like build an automated system for deals. From there, later on, a bit later, like as COVID started, so I was started being concerned on the market side. What's going to happen to the market? Do we know if the market is actually expensive, or is it cheap? Is it overvalued? Is it undervalued? And then I started doing kind of historic fundamental analysis studies. They're of the type of what some hedge funds do, like Hussman Investment Trust, and it's kind of like, for people who know, some of the people in the audience who may know finance, things like, in a way, like based on price earnings ratios, but like more evolved model on that. And so I started like, okay, doing like fundamental analysis in real estate and kind of assessing markets for how overvalued, undervalued, fairly valued they are. And the goal for me was, okay, to know, am I currently in the markets that I'm investing in? Are they overvalued? Should I continue investing? Should I stop? Should I wait? Like this constant question that investors have. And that gets partially helped by, being able to find good deals, being able to do value add, like with the value add strategy, significantly helped for sure. So you're able to do it, but still you don't want to have the market exposure or downside risk on top of that. So from that point, I got into the market side And then I've been building like some other models. So we just released today financial modeling for commercial multifamily off-market properties. It's sort of like an improved version of like feeds you would get from companies like Prospect Now or Yardi Matrix or things like that. That kind of gives you like insights into how you can improve the net operating income on various properties and which are actually the good properties in your market to focus on. And so that I've been doing some machine learning a bit, because if you want to kind of do automated underwriting or a data-driven approach, so data-driven approach fundamentally is very much automated underwriting. And then there's also market side. But then automated underwriting, to actually do it, it takes end-to-end, it takes machine learning, and it takes, being able to read and to see images and things like that, right? So kind of computer vision and natural language processing and things like that. So I've been getting a little bit into the natural language processing side of that. Can I extract, different structured data, textual property intelligence from descriptions of properties in the commercial space, residential space, etc.? Can I build this? And I also teach a data-driven real estate investing course at Realty Quant. So I have that, and that one goes over like 10 different modules of like data-driven investing and like sort of like more like basic fundamentals and core technologies.
Great, I love that. So there's multiple underwriting models out there, because multiple people have built their own Excel model, and they wanted to put certain assumptions in there how the property is gonna perform. Like I'm talking about the commercial property. Since you have done your homework and you're talking about you build multiple models from residential to commercial, and even conversion from residential to commercial as well. So if you can share with me, what were your findings or how your models are different than the other models in the market, and which one is more effective?
Yeah, I mean, that's a great question. I mean, in the commercial space, so what I do is a little bit, it's different because the problem I'm trying to tackle in the commercial space is not, if you have a single property and you underwrite it and you put it in your, I know what people use, like Michael Blank deal analyzer, let's say, plug it there or something, apparently for him. So let's say, and you put it in that, or whichever, you have another spreadsheet that your analysts put together, your underwriting analysts, they put it together, and you have a spreadsheet and you plug in, compute your IRR, things like that. It's not so much my focus in this sense. It's more my focus was from a data-driven perspective across many properties. Can I take the off-market inventories for commercial multifamily in the whole US, let's say, and model them for their NOI improvement potential and find only the good ones? And then if someone is sort of perhaps also not vertically integrated, but kind of better, more like data-oriented commercial investor who is somewhat flexible for markets, who may look at primary market, perhaps secondary, even tertiary in some case, or who may want to look kind of across the US, can you get a preliminary underwriting of those? So it's not the true underwriting you do in a spreadsheet on a property you already know, that its income expense parameters. It's more like, can you get, and that one is not based on rental listings data. So it's kind of a specific insight of, we can try to use rental listings data to infer, which buildings have rents below market, which buildings have perhaps are not charging pet fees or administrative fees, and other buildings, apartment buildings or communities in the area are charging those, or perhaps they're not billing back utilities and other buildings are doing that, or so forth. And so it's really getting insights into the income and expense side based on rental listings data. And that's more scalable, because the other one, you have a single property, you plug it in your spreadsheet. This one is, let's give an example, like the set I'm looking at today is 32,000 apartment buildings. And so it's like, it's a different thing, but it's a less precise thing. It serves a different purpose. It just serves to have more intelligent marketing efforts. So whichever way you're trying to approach those properties, be it, perhaps in your market, you have relationships, you take the owner to coffee or something like that, or you just are doing direct mail campaigns, or even for your agent relationships, in whichever way, it helps to know kind of the prized assets, the assets which are already with a value add component. And so that's like what I do. Now, as far as the other underwriting, I haven't done too much. I've looked a bit into theoretical cap rates. So some people may follow like Professor Peter Lineman at Wharton. I think he has the best material on cap rates. So as far as like other models or forecasting in the commercial space, I would follow that because, and I did a video recently for my YouTube channel where I was talking about okay, comparing theoretical cap rates to something in finance. It's called the Gordon Growth model, which is a model for discounting dividends. And it's a very interesting, in that kind of people can check it maybe for that not to go too long, but that gives an insight as to, okay, the cap rates, interest rates relationship that I think is a better insight than the usual one, okay, or if just interest rates rise, cap rates necessarily rise and things like that. It's a more intricate thing. It incorporates like the growth of future income and so that's kind of like based on the more theoretical model. But on top of that, Peter Lineman has a forecasting that they do. And the paper is free and it's being published by his team or like Bruce Kirsch or something like that, who has like a real estate financial program that are like certificate program or something like this. And so that's the best way I think to forecast commercial multifamily forward that I have seen personally.
So, but the cap rate is not the only indicator, right?
Yes.
There's other factors involved too.
That's true. Well, that is true. The cap rate is not the only one, but it's sort of a big one. It's sort of like, for instance, in finance, I come from like derivatives trading. So, okay, in options trading, it's not, volatility is not the only thing that is the price, but it's a big thing. And so then traders may kind of quote, instead of the price, the volatility. And so it's a little like that. If you're in the commercial space, the cap rate, it's not the price, but it sort of is a little bit the price because it's like, it's such a big determinant. And so people care, if cap rates are gonna, compress or decompress and so forth. But I do agree. Yes, it's true. It's not everything about the pricing, because if it was, then if let's say if an interest rate increase causes cap rates increase and that causes prices to decline, that would be too simple. That the real estate prices are sticky to the downside. They don't decline so much. That's not how it works. So.
That's true. And I understand you wrote an article too about real estate market valuations. So what is the concept of valuation in your perspective?
Yes, so that's that works really well in the residential space. So market valuation is the concept to implement kind of fundamental analysis to real estate and to essentially take the fundamentals of income, like household or personal income in a market, that people have, and also population and housing supply, and to take those and to search for deviations of prices from those fundamentals, from where prices would be based on those fundamentals. And so this model worked really well during the global financial crisis. And a very simple version of that people can do, by the way, is if you just take changes in price income ratios. So it's not price income ratios themselves that do anything, but changes in them on a kind of moving average window that can keep shifting forward, do predict really well declines after a recession. And so that's what they did at the beginning of COVID. So I did like this study for global financial crisis. So I took like price income ratios in different markets and deviation from those. And that's been practiced by many people. It's not something I have invented in any way. But what I did is I calibrated and tested how well it works and like did it the specific figures. And so it had like 85% correlation to subsequent declines in different US states. And then for like the 3,000 counties, and so the correlation was like 75%. And then I went back more recently. I didn't have time to do it before. I went back more recently. I did it for like the previous recession, so such as the 1990 recession. And 1990 recession is an interesting one. It kind of could be like a scenario for now, let's say, if we do have a recession, like a very mild case where not much happened, and real estate doesn't decline much. But even though real estate broadly did not decline at all, it had in fact a 0% decline. All the overvalued states did decline. And so market valuation worked in basically exactly the same way as the global financial crisis then, even though there was no crash whatsoever. And that even kind of puts like some kind of conceptual, like some question on like what that crash is even during global financial crisis, because it's really, it took 4 years and 1 quarter for it to happen. So it's a very long time. And so yeah, so that's kind of like gives you like having, so market valuation, again, it's like the deviation from fundamentals essentially. And so the argument is, this is not the stock market that has a significant technology component to think that it's extremely stochastic and extremely difficult to understand. It's not. It's a very fundamental driven thing. You can know valuation. You will not know the exact declines that may happen simply because you can have a very strong economic recovery. And then let's say prices start declining, and they decline very, very slowly. In other words, like say it takes like 4 or 5 years, literally, after every recession. And so they start declining slowly, and then your fundamentals, let's say, recover really strong, and then they kind of meet, and you end up with perhaps a third of the overvaluation as a decline. So that's a scenario. Or you have the global financial crisis, and they start declining, and fundamentals don't recover, and they end up fully kind of with the full amount of the overvaluation declining. And so that's an interesting thing, but it's important to know that it was applicable even in cases when there was no crash whatsoever. So, and it's applicable to a point where investing in an overvalued state, and I speak of states just as like very high level discussion, and because it's like very also, let's say like extremely statistically predictive there. The numbers there, I look at them almost as hard data that is almost as the price I'm paying in a way on the market level or something like this. And so, for example, in that recession, 1990, so the state of Hawaii was like 48% overvalued. That was the best performing state in the US, had appreciated like 150%. So that's like an example of an extremely booming place. A comparable market now could be, and kind of time will show, could be Idaho. That is like about already over 50% overvalued. It's a very big exception. The other ones are not so much, but kind of like really overvalued Western state. And that is also the very top performer in price appreciation this market cycle, with Boise being at the very top and so forth. And then Boise has been reflected as like the most overvalued city in the US by Moody's Analytics for the Atlantic University, as well as my company as well, Realty Cons. It's kind of pretty consistent observation. It's not something that I think even with different methods, and so forth. So it's very hard to detect, very easy to detect, I mean. But yes, so Hawaii serves an example of, okay, there's no real estate crash, but you invest ahead of a recession in an overvalued place, overvalued market or state in that case. And the prices in Hawaii 8 years later were 14% less than in 1990. So that's the impact of investing in a very overvalued market. It's not, okay, prices are going to decline, it's some kind of doomsday scenario or something. No, it's just that market is going to be, may underperform in the next cycle. It's going to be likely to underperform. And it's very counterintuitive because you're looking at that point of time, you're looking at the market that was the very top performer. And so that's like what's very hard for people to understand now that I've been talking to who, let's say, invest in like some of the very peaking Western markets, that they look at the very extremely strong fundamentals in those markets and they're saying, okay, how are you saying that it's overvalued or that it's not going to continue booming if it has that housing shortage that is there and all that stuff? Well, housing shortage is reflected in the price actually, because you have in the valuation, because it's actually kind of, if we take something like affordability, like price income ratios, they shift in time, like according to kind of housing shortage, like population to housing supply ratios. And so they end up, for example, in like cities that are like really expensive and not affordable, like San Francisco and New York, they've kind of been built over decades to a point where, there has been so much shortage. And like at some point, like the affordability is, it's like really not affordable. Like the prices are many times the incomes, like or something like this. And so housing shortage, or at least this broad housing shortage, because like people in the residence, they talk of housing shortage a lot, and there's like these new homes and that they're underbuilt, and this is true. But this broad housing shortage of total housing units in the market and how much population is there is reflected in the valuation. And so if you have a market that's extremely booming, so incomes are growing, population is growing, housing supply is not catching up with that population, but prices have appreciated way above that, significantly above that. Well, that's it. It doesn't matter that it's growing. It's like prices are way too high. That market will be likely to decelerate in the future. And that has been the case for all those booming markets before, ahead of recessions, that almost by default, their fundamentals have been extremely strong. That's why they're there. And that's kind of also correlated with how they end up overvalued, because it kind of get overheated and investors want them too much. But from that point on, even though that market has these extremely strong fundamentals, perhaps they would help it to decline less. And that's a good thing. So it's still a very good thing, but it's still going to likely to underperform after a recession, a market that's just not overvalued. And so like other markets in that case, they kind of went like 50% higher in 8 years. And then that best performing market that was the overvalued is like 14% less in 8 years. So it's kind of like a lost almost decade, of investing, something like that. And so that's kind of like, those are like some considerations. And
That's good. But some markets are like always on the, they have a growth history and the growth trend. So what are some of the factors there, like why these markets are growing, like you said, New York or San Francisco. So these are the highly expensive markets and it's like, I would say high barrier to entry for the average investor, right? So what is your take on that? I mean, what do you predict what's going to happen in the future to these markets? Are they going to come to at a level kind of, that is like more approachable for people, or is it going to keep on going high?
That's a great question. And so my answer based on like that is they're not going to become more affordable. They will stay, they could become more affordable to the extent, like if their incomes kind of grow too much, they could a little bit start becoming more affordable, but generally they would stay as expensive. They would most of the time remain expensive unless the city really goes down and like the population heavily leaves that city and so forth. They would remain at, let's say, 20 times prices, 20 times income or something like that. That is just a place that is difficult to live in, right? But that stays the same. That's what that doesn't go down. So but that's not a predictor of price decline if a place is not affordable. Like the predictor of price decline is, for instance, a place that can be very affordable, but has deviated too much from its very affordable level. So that's, for instance. And so those not
outliers.
Yes. So, right. Those not affordable ones, it doesn't mean anything. It's just like an absolute figure of that it's not affordable. But in fact, at the current time, I can tell you, San Francisco is undervalued. It's very not affordable. It's undervalued because people left it as hell, like population also left and so forth, a little bit too fast, maybe even for models to detect and so forth. And so it's showing up as undervalued, and New York City is fairly valued. So those most expensive places is not where the housing bubble is. The housing bubble is where, it's not a bubble, I don't like the word, and I don't even think it is, but sort of some level of overvaluation is where the markets that were thought to be cheap, even like Nevada or Arizona and places like that were thought to be cheap, that are affordable, relatively speaking, but they are too deviated from their historical price income ratios.
Right. I was just like thinking about this question. I assume that you use some business intelligence, some strategies, some technologies to take the historical information and convert into more, I would say, useful information to predict the future or predict the future of the market. But isn't there might be some elements like human, the emotion, or like, for example, today's generation is more like experiential generation, not like totally different mindset. How does that affect the market, or is there any effect at the macro level?
I mean, yeah, that's a really great question. First of all, I guess for sure at the property level, for property underwriting, like I guess most of us investors know that just simply like doing data and so forth is not sufficient, right? You have to talk to people, look at the property in person, like get like a whole picture of it, right? Because it's a physical asset. So that challenge always remains, and like it's an extremely human element that has to close your deal at the end, right? And so forth. Just the data-driven part kind of helps you with the deal search and helps you kind of be more organized at the previous stage, like before the final like human element. Now on the market side, it's a good question. I don't I have a very high level model for only predominantly for downside risk. I don't try to discover all those intricate, there's like machine learning companies that they look at, let's say, like if the breed of dogs in the neighborhood is changing from one breed to another, and maybe that's an indicator of change in the neighborhood, or like coffee shops appearing and things like that, right? So there's these methods based on social media signals. They're good methods actually, and they can work, but it's not something that I do, because I do appreciation forecasts also, but my appreciation forecasts, I literally do like trend kind of momentum picking, and I just follow like the trend essentially in markets, because that works so easily in real estate. Like there is this like in statistics that you test trend by autocorrelation, and so the autocorrelation is pretty high in most places. Like in Florida, it's like close to 80% for real estate prices and so forth. So there's a lot of momentum, and so that's what I use in appreciation forecasts. And it actually, one thing to note, and I don't use like indeed like the more intricate human things, and they are valid, they can be valid, but they do get built into those prior prices as well. And I feel like that's the easiest and best and probably most accurate model that one can have. And so one example to illustrate that is, if you know, like how investors and investment managers who invest out of state, let's say, they would pick their markets and they would kind of tout the virtues of that market for its job growth, population growth, and so forth. But I did a study where, I forecasted population growth, income growth, housing supply in different markets, and then forecasted the prices of those fundamentals. And then on the other side, all I did is I just took the historic prices and just forecasted the prices themselves. And I had a 5 times bigger error with the fundamentals approach for forecasting than the first one. Yeah. Wow. And so the reason, which is kind of funny, because so the way simpler thing of, if people they don't need to do any statistics or anything, they just look at historical prices in the market, that it works best for forecasting appreciation while we stay in the same market cycle. Now, if the market cycle changes and let's say prices decline or something like that, then it's different, or if we have an officially declared recession. But until then, like that's kind of the best predictor prices. It's quite interesting. Yeah. And it's been coming quite close at forecasting, for instance, 2018, 2019 prices. When testing that, one gets to like within like 1.5% of the true price or something like that. It's pretty close. But if you go the fundamentals route, which is like inherently what like most an investor would do, because you kind of want to justify to your partners and so forth, right? Or investors, you want to justify, okay, there's this population, there's this, and it's a good sanity check. But it's just not as such, it's hard to be super accurate in purely price forecasting in that sense. And so that's kind of, so in that route, I had like a 7% error, which is pretty huge. And so it's a little hard to forecast prices of that, because there are also exactly these irrational factors to an extent, or like that you mentioned, that people can just, or investors can just start overbuying in that market too much. And that's not reflected in the fundamentals. And so I would want to have this irrational component also kind of predicted better from the price momentum itself.
So let me ask you one simple question right here. I think this is the right time to ask you this. For an average investor's perspective, like me, please share with me what are some key indicators that I should pay attention to, like, oh my God, my investment is going to grow here, I should invest here or not.
I don't know if you're an average investor. Okay, but in terms of market selection or in terms of property selection?
Yeah, market first of all, or because market is important, because investors are mostly hesitant, and like say if they wanted to invest out of state, they're not 100% sure about the market, they're not sure about, and they do not know much about the market, So what could be a good indicator for them? Okay, this is a good market, or whatever this operator is telling me is good. And the secondly, even the property itself, how can you differentiate?
Yeah, that's a good question. I mean, for markets out of state, I mean, besides like all the more qualitative things of, like do you like what the neighborhood is, and I mean, some of it is quantitative, but like kind of like what is, like the demographics, are they like healthy in income terms and so on and so forth, and Do you like that neighborhood and so forth? So besides like those factors, the very important, in my opinion, it's part that I spoke about already, is market valuation, because it's just not used in the industry. And so that's kind of, I think that's the value add, because I know that I speak to a lot of investors like syndicators and so forth in space. I know they're missing that. And so I'm aware of this. and so because they're missing that, so that's like the real value add, because that tells you, think of somebody like Warren Buffett in like the 70s or something. That just tells you you're not going to buy a market at a premium, right? It's the same thing that real estate investors do really well at the property level, to buy discounted properties. Nobody will ever pay a premium or something for a deal, generally speaking, right? I mean, unless something, I don't know, maybe there's a huge value on the back of that premium or something, and it's still not a good practice and too risky. But nobody would buy a property at basically every investor at the real estate investor at the property level is like a Warren Buffett in the stock market. But they are not a Warren Buffett in the stock market when it comes to market selection. And that's been seen like kind of over and over. And that was even a global financial crisis, like some of the best investors who were in the single family space specifically. And it's less indeed in the commercial multifamily space. That has been like less impact perhaps there. But a lot of the really big investors in the single family space, they actually, they kind of lost their net worth during global financial. And that's didn't have to happen because it was completely predictable, not the magnitudes of how much markets will decline, but it was predictable which are the overvalued ones. So it was, one could avoid it, because investing in an undervalued market at the time meant almost zero downside risk. They actually dropped on average 4% only. So that's the global financial crisis, like the biggest declines. And if you're in an undervalued market, basically not much happens. And so that's like, for me, like the most important variable when it comes to kind of risk management and market selection that you start with. And from there you build on with, okay, what's your appreciation? What are your appreciation expectations? Are you going to base them on the momentum? Now, if we're having a recession, how do you do that? Are you going to, perhaps now you should do it off the fundamentals this time, because there's not, if indeed there is a recession, perhaps you should do it that way. Like you can just look for like the stronger fundamentals. Then what are like all the qualitative factors and like other things that you like about that market? Do you like the neighborhood, the type of, is it suburban also, all those things, like kind of suburban trend and so forth. But for me, like this comes afterwards. And so that's like my perspective on it's just very important to pick markets that are not overvalued at the current time.
Yeah, and earlier you were talking about the market cycles, right? So yeah. How do you determine when is a good time to invest?
For me, if you buy, so if you track, if we think of prices relative to fundamentals, and we have, let's say, the normalized prices normalized by these fundamentals, and we have that just takes out the whole timing out of the question. Because I know, like for real estate investors, because they're running a business, because they're able to generate value through their own efforts by forced appreciation, right? And so they think, okay, we can invest at any time, which is true, because they're functional, productive business owners. You can operate in a recession productively as well. And so that's true. But there's still some market exposure on top of that. And so to me, though, if one simply has the normalized price, and that's something that, again, like it's a realty quant. So my company, we do provide it as a service. So, just putting it out there. And so, but there are other ways you can do it yourself, or you can reach to me for how, if you want to set it up. It's a methodology, like I'm very happy to assist with that and like advise. But again, like if people want to, if people have that information, like normalized prices by fundamentals, then they would just essentially, they can buy at any time. It doesn't matter anymore. Is the recession, is another recession. If you're buying at 0% or minus 2%, it's the right time to invest, especially for a productive business person who is going to generate forced appreciation or generate, like some kind of renovation value or things like that. And so it's definitely takes out timing, the question of timing, at least for me, because for me now it doesn't matter. I don't care now if it's a recession or it's not a recession. I just invest where it's not overvalued, and that's it. So.
So the interest rate is on the rise now. So still a good time to buy?
Yeah, I think it is a
Time
good
to
time.
invest? Mhm.
Yeah, well, it is a good time to invest with operators who generate value. It's not perhaps the best time, or I don't know, that part I don't know, could be still a very good time for
That's
just
true.
for appreciation. It could continue, I don't know for how long, because I don't know the timing. But let's say, assuming if we did get a recession, then it's less a good time, for, of course, for appreciation in that sense. But it is a good time to invest with operators who generate value, via their innovation or forced appreciation and so forth. So definitely it is, but it's better to know that those operators are not going in the kind of hot markets, in my opinion, and that they are also protected on the market side. That's even better, because then you're further like protected on the downside risk. So.
Oh, great. Thank you. Oh my God, I can keep on talking to you. I'm sorry we're short on time. So share one golden nugget with my audience before you go.
Yeah, that's a great question. So golden nuggets in terms of like finding deals or like
Yeah, so investing, give them some tip on investing, how they can, compare that to investments, like which is
okay.
good, which is not.
Yes. So my opinion. So if we think of like general kind of, let's say if we think of private equity as a space where kind of you are able to control or somewhat affect the valuation of businesses or properties and so forth. So you have control over valuation. And now in real estate, that is the thing that people call forced appreciation. And like to just some of the audience who may not know, forced appreciation is when you kind of raise the net operating income of the property, raise the value of the property. Or, I mean, in theory, one could think of it in the residential space as like doing another physical or non-physical alteration to the property and affecting the value of the property through your own efforts in a deterministic way. So that's forced appreciation. And so for me, like my kind of nugget, or how to say, like strategy. So I feel it's easiest to do this on a relatively short horizon in the small size commercial real estate. So I feel, in my view, if people want to do their own deals, rather than investing with bigger operators. So investing in kind of like 20 to 40, like those small, they're very operationally inefficient indeed, properties, but they are very quick to turn around. And that is a way to raise your net worth very, very fast. If you want to like 10x your net worth or something like this, it's not the residential space flipping, because you cannot get a huge, and so in that scenario, so I had a friend of mine who had shared like two case studies. He does like bigger commercial properties, but those were two smaller ones that had 7x and 8x equity multiple in what the horizon was like about 2 years for each.
Wow.
And yes, and so 7x or 8x, so that's kind of the golden nugget. So why is that? It's because you're able to compress the time really much on those very fewer units, and because you have the valuation, the commercial valuation method. And so and that comes at the expense of course, huge effort and like very operational inefficiency and not a good property manager and all those things. It's true. I'm not saying it's better investing than where institutions invest, but that's the way to raise your net worth at the beginning.
That's great. Thank you so much. I love that. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You're going to answer in one sentence or one word only. Ready? Okay. So the first question is, what is one of the best skills that you have learned over the years that works for you all the time?
Data.
Data is good, right? We live in the information technology age, so gotta be good. What is the best book that you have read or recommend to my audience?
I read a book called When Genius Failed. When Genius Failed, that's it.
And Genius Failed, that's a good one. What is your biggest passion?
Biggest passion, kind of intelligence, pushing your boundaries, intellectual.
Yeah, data and BI. That's what I was thinking too. In one word, what does life mean to you?
In one word, productivity and reaching limits. That's what.
Good one.
Yeah.
If you got a chance to change one thing in your life right now, or even previous, and you going back previous in your life, what would that be?
Quit my W-2 earlier, get into private equity earlier.
Wow, I like that. How can people reach out to you, Stefan?
Yes, so my website, realtyquant.com.
Thanks for being on my show. I really enjoyed our conversation.
Thank you.